The Reserve Bank today probably surprised the market with its hawkishness. Yes, it didn't change the repo rate or its stance as expected, but given that the US Federal Reserve is now expected to cut rates by 125 basis points in 2024 versus only a 25 basis point expectation during the June policy, some in the market expected Reserve Bank to sound a tad dovish. On the contrary, there were signs of hawkishness in the statement and in the press conference. The CPI forecast, inflation forecast for the current July, August, September quarter has been upped to 4.4% from 3.8% earlier. That is one sign. The second, the Reserve Bank has forecast inflation for the first quarter of FY26 next year at 4.4%, whereas in the MPR, the Monetary Policy Report in April, they had forecast it at 4%. That is the CPI for FY26. So, is the RBI correctly cautious, rightly cautious, or is it overcautious? What about its other warnings on poor deposit growth, on top-ups on home loans? To answer all these questions, I have with me an elite panel. I have Mr. Dinesh Khara, the chairman of State Bank. He's joining in just a bit. We are also joined by Mridul Sagar, who is professor at IIM Kozhikode, but a former member of the Monetary Policy Committee and ex-RBI ED. B. Prasanna is the head of Global Markets Group at ICICI Bank, and Savinan Chakraborty, chief economist, Citi India. Gentlemen, thank you very much indeed for your time. First, this doubt I have. The expectation was that maybe, some wriggle room they will make for themselves in case they have to, cut in December or earlier. Mridul, what could have been the thinking of the Reserve Bank? Why didn't they allow themselves that wriggle room?
Latha, I think the biggest problem which a central bank faces is that if it indicates that if there is a shift in conditions, they might pivot, then they will prematurely ease financial conditions. If you see data hard, I think the banks have already lowered the lending rate instead of raising the lending rate over the past 2 months on the fresh deposits. That's the RBI data which says. On the deposit side, they have not lowered, just 2 basis point fall is there in 2 months. But on lending side, there has been fall. So if you give a signal, then probably the deposit rates would ease at a time where there's already a huge issue about the mismatch of credit and deposit ratios. So the incremental credit deposit ratio being pretty high and including the investment number. So banks are growing at 128% roughly of the deposit growth. So there is this liquidity angle which the governor hinted at and which I had also mentioned in media around a week back about the financial stability risk emanating from it. So I think that's what is keeping Reserve Bank on cautious, and inflation has risen to 5+, whereas the target is 4. So it's very difficult to sort of signal. If the pivot comes later, it would be when already sort of we see hard numbers that the growth is getting affected, which is not the case as of now.
Okay. Yeah, which is what the governor also pointed out, that we still don't have any clear evidence of a US slowdown. But Mr. Khara, welcome to the show. Thank you very much for your time. This is a very important point that Mridul just made, if you heard him, that actually banks' loan rates have gone down a bit in the past few weeks, although there is a war out there for deposits. Can you explain? This seems to have, impressed on the Reserve Bank as well. How do you drop lending rates when actually your deposit costs are clearly going up?
I fully agree with you, and that is something which you have seen. So actually what has happened is that there is a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill, and today the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. So this is the kind of a market where we are all operating today. So some of the loans are linked to MCLR, some of the loans are linked to T-bill, and it depends on the bank and the kind of interest rate benchmark which they are following. So much of it is actually guided by that. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various subsegments in the market, and they're all getting priced differently. So that is something which is a
would
reality.
you? I agree, sir. There are several markets out there. But would you say that as a consequence of several factors, the LCR rule, the bond index inclusion, we are going to see market yields go down, but because of, the dearth of deposits, deposit rates will go up. Are we therefore going to see bank margins getting compressed as also borrowers moving to the market and not taking loans?
See, not all borrowers can move to market. This is a reality which cannot be ignored. And also not for every kind of facility they can move to the market. So I think even market has got its limitation in terms of their capability to absorb such kind of business opportunities. So I think we'll have to probably wait and watch. This is a point of time when we are at a cusp of various evolutions, and we'll have to probably wait and watch and see that how really things stabilize in the days to come. But yes, of course, at this point of time, each of the players is playing according to the opportunity which is available in the market.
Okay. A final question to finish this theme. Mr. Kharat, do you think that loan bank credit growth will taper down to meet the deposit rate? I mean, if the deposit growth, for instance, for SBI is 8.8 and loan growth is at 12 or 13%, sooner or later, even for the industry, loan growths have to taper down, isn't it?
See, again, here it will depend. If at all there are opportunities for in the loan market to fund this kind of a growth, bank will have to think in terms of at what rate they can raise the resources. Okay. See, for instance, I would like to draw your attention to the fact that way back in 2004, 5, 6 also, we had seen a situation like this, where the deposit growth was much lower than the loan book growth. Those are the point of time when CD market actually evolved quite a lot. So again, now we have seen that, infrastructure bonds are becoming popular. CD market is becoming popular. If at all there are opportunities to lend and the kind of risk which the banks would like to lend, I'm sure they will be in a position to raise their deposits. It's not that deposits are not available, but the price at which they are available, will that be something which banks would like to look at it? That is something which has to be kept in mind.
Got that, sir. I'll come back to you for the other points that he made on top-up loans. But let me finish the economic arguments. Samiran, what is your sense, given the macroeconomic data that we have, the evolving circumstances globally, when would you position the RBI changing its stance and stance and rate action?
Thanks, Latha. I guess what is coming out of the RBI communique is that RBI is definitely have an unwavering commitment towards getting inflation down to the 4% medium-term target. What is helping RBI is twofold. One is that the domestic growth numbers are coming out to be quite robust and resilient. And second is that if you look at the overall financial conditions, which includes banking system liquidity, equity markets, credit markets, FX markets, and put it into one index, that overall financial condition index is still on the so-called easy territory. And that's why RBI does not need to cut interest rates very aggressively to support growth. And the last point I would make is that if you look at how the global situation is evolving, there is just so much uncertainty that it's very difficult for any central bank to be proactively taking interest rate calls on the basis of that. So given where our current growth and inflation forecasts are, we think that the first rate cut could be deferred till April 2025. Maybe the stance change happens just a little before that. But as of now, there is no urgency that is there with the RBI to tinker with rates. And as the governor has always maintained that for orderly evolution of financial markets, a stable and predictable policy regime is what is warranted. And the RBI is delivering on that front.
No, I take your point. Actually, the RBI very cleverly did not hike rates but made liquidity tight last July when inflation numbers came in at 7.8, and they have effectively given a rate cut by bringing back the liquidity, so to speak. So the call rate has clearly gone down from 6.75 to 6.5. So that perhaps would count as a rate cut, a stealth one. Prasanna, do you think that the Reserve Bank was actually defending the currency?
Well, that's an interesting question, Latha, but I mean, you can never tell what really goes in the minds, but it's quite a possibility. And yes, they have been a little bit more, I mean, first of all, I don't think too many people expected them to be dovish, but we all thought maybe he will give into a little bit of dovishness in the post-policy conference. But even that did not come through. But yes, it's quite possible, but I don't think there is a real direct linkage between the way INR will behave or the currency will behave and the kind of stance the RBI is taking. Actually, the RBI has been quite hawkish for all this time, and hence the focus on inflation, like Samiran was saying, has been quite pronounced. So to that extent, it's just a continuation of what they have been doing earlier. And I will just refer to a statement that he made in actually an interview with you, Latha, where he said that giving guidance is something that he doesn't want to do. So when there is just one set of data which has come from the US, which is seemingly indicating that there is a much bigger slowdown than what you are what markets were expecting earlier, he probably wants to see a little bit more data before he gives in to even a change in stance. So my feeling is that he'll probably think about the stance change in the December policy. That is because he would have had a couple of policies from the Fed by that time where there would have been a couple of cuts priced into the market. So I think we'll have to wait and see. At the way in which they are talking, we can't see a rate cut happening anytime soon. But I do feel that at some point of time, the emphasis will shift to growth, which is when they will really start talking about a stance change and a rate cut.
Okay. A final question before I take a break. Mridul, I mean, no one can tell the future really, but what are the chances that the Reserve Bank could be making the mistake it made in February of 2022? You were there. If you remember, at that time, the Reserve Bank had spoken dovish, very dovish, 4.5% inflation forecast, and then comes the Ukraine war, and, all hell breaks loose. So many hikes after that. Inflation changes. Now we are getting a smell of the global economy, the way it may pan out. We don't know. If indeed 125 basis points cut were to come, will this policy be remembered as possibly a policy mistake?
There is a small possibility of that. But the point is, in this policy, it was difficult to put it in the baseline because clearly, though equities had corrected big time, I mean, especially the Nikkei falling around 11% from mid-July, S&P around 7.5%, Indian stocks less, roughly 3%, and so. But these would obviously start changing from the financial accelerators it will generate. Probably it will slow down the global growth unless Fed pivots a big way. And that might be difficult for Fed to do at this juncture. So if global growth slowdowns, India cannot be decoupled with that. And there will be some effect to the 7.2 growth forecast the central bank has. I'm not sure it will fall as much as 6.5, which the economic survey says, which to my mind was rather a number which supported a fiscal GFD to GDP ratio, which looked more credible at the number there of 4.8, which was put in the budget for 4.9. If you assume a nominal GDP growth of 11.5%, this number could have been 4.4%. So the nominal GDP projections of the government were a big constraint in the growth numbers. So I see it would be somewhere averaging between the RBI forecast and the government forecast. And there will be some pressures coming down later in the year or early next year for RBI to start changing the stance and give a notional rate cut. But let us be mindful of the fact that RBI is just around neutral. RBI has never tightened in this monetary cycle. So if your neutral rate is what RBI has indicated, then you are at the neutral. Whereas Fed has raised it to 525 basis point, and therefore they have a room to cut. RBI doesn't have a room to cut.
That's absolutely right. For all you know, Reserve Bank is going to have the last laugh, and this question, is superfluous. And as Samiran and Mr. Khara have pointed out already, it's not that the conditions were tight in the first place. Okay, I'll have to take a very quick break. Coming back to check with all of you what will be the movements in the bond market and your analysis of the economy as well, and the important statements the governor made on this top-up loans. Coming back in a minute. Welcome back. We have been discussing with an elite panel of bankers and economists, Mr. Dinesh Khara of SBI, B. Prasanna of ICICI Bank, Mridul Sagar, former RBI Executive Director and member of the MPC, and Samiran Chakrabarti of Citi. What they made of the monetary policy and how the economy and the banking system evolves here on. Mr. Khara, there was a mention that banks are giving top-up loans over both home loans and gold loans, and that's something that's worrying the RBI. We have also seen actually an increase in NPAs in several quarters. MFIs definitely, but even some unsecured loans. Do you think that the best of the asset cycle is behind us, especially in the retail sector?
Well, I think the concern which was expressed by Governor was essentially coming from the fact that some of the banks are not looking at the end use of the top-up, etc., which has been given for the home loan as well as for the gold loans. So that is one of the reasons. And when it comes to the LTV ratios which are being looked into while extending these loans, and also EMI, NMI ratios which are being looked into, this was one of the major reasons when for the unsecured loans, the RWAs were increased. So now this kind of practice was seen in some of the quarters, and that is one of the reasons why this was flagged by Governor in this policy statement. So I think, here again, depending upon, we have seen that in some of the MFIs, we do see some such scenarios, but as far as we are concerned in our book, not really much of change which we have seen in terms of behavior. So I think, again, it's a very fragmented market. In certain segments, perhaps it is seen, but it is not a universal behavior which we get to see.
Yeah, he made it clear that it is only certain entities. He repeated that phrase. But, there are some NBFCs and MFIs where the numbers looked quite bad in the first quarter. And very quickly on this matter of, higher liquidity coverage ratio, which is imminent, are you getting a sense that they will give you more time? Because when we asked him that question, he said it's only a draft. There was an emphasis on only, which gave a sense that it's either diluted or delayed. I mean, did you personally have any conversation with him?
Well, I think
anyone in RBI?
In fact, we are all sharing our thoughts on this particular paper, and we are sharing through IB as well as directly also. And I'm sure RBI always gives us an opportunity to explain our stance. They will be very mindful of what our views would be, and only then some regulations will come.
Okay, that's good to hear. Twofold questions to you, Prasanna. If this goes through the LCR, there is a huge, people are guessing between 3 lakh crore and 5 lakh crore demand for bonds. And to that extent, credit will also fall because, banks will put their money into HQL, into bonds, and not give it as loans. What is your sense about what can happen to the bond yield over the next 1 year, over the, say up till December or up till March? If you can give me a range, if the LCR rule is as is, and if the LCR rule is not as is.
No, but Latha, a broader point actually, I think, refer to the fact that we have repeatedly spoken about financial conditions actually being very easy. But that is if you look at the financial and capital markets like you spoke. But if you really look at outside of it, there has been a craze for getting deposit growth, and there is actually all these, even the LCR guidelines, for example, presses interest rates in the system on the tightening side. So you have this contrasting pressures which are happening. And so to that extent, I think there might be at the margin some kind of a shifting of funding which could happen. But at the same time, like Mr. Kara said, it might not be viable for too many corporates because it's only the better rated corporates who can really access the capital market. But on the issue of SLR, on the LCR itself, I think, see, the calculations depends upon what percentage of retail deposits every bank has and so on and so forth. But broadly, people have made around 4 lakhs to 5 lakh crores as the incremental GSEC demand if people will have to want to keep the same level of LCR ratio as they were keeping prior to the guideline. Now, that is again a call. People could say, I mean, the banks which are maintaining, say, 125 to 130, 135% can probably dip into the cushion a little bit. So even if you assume, say, 3 lakh crores of demand comes in and not 4 lakh to 5 lakh crores, that's nearly around 20% of your annual, supply. So to that, or maybe 15% of your annual supply. So to that extent, I think it does make the demand supply situation favorable for government bonds. And also bear in mind that this is the year when you get the one-time index inclusion flows also coming in. So net.
So what is the range?
So I think it is a gradually, it's a narrow trading range that is happening, but a range which is consistently going down. I would say it's around 685 to 690 in the shorter time frame. But over a medium-term time frame, I think it can inch towards 680 or maybe even slightly lower than 680. But this is all subject to, US data playing ball. You're not really surprised and at a hawkish kind of a Fed and all that. So all this, taking into account, I think looks like 680 seems like something that we will gradually move to.
Okay. Mr. Khara, I can see you looking at your phone. I'll thank you for sparing time with us. I know it must be a busy day for you. Thank you very much for being with us. I'm not done with the economists and the bond expert. Samiran, a similar question to you. What are you expecting in terms of a bond yield? But more importantly, what are you expecting by way of currency also? We keep writing for headlines' sake, all-time lows. But the rupee has actually outperformed. So your range for the rupee as of December 2024 and bonds.
First on bonds, I think the bigger move, already a significant move has happened on the back of the positive macros, including the fiscal being very conservative, inflation numbers behaving quite well, global deflation story picking up steam. From here on, the next leg of the move has to coincide with farm rate cut expectations from RBI. That, in our view, is probably delayed till first quarter calendar of next year, fourth quarter fiscal. That's when we expect yields to drift closer towards 650, 660, 10-year, that sort of a level. And on the currency side, we have practically forgotten looking at the valuations of the currency. And if you look at the 40-country RER, that went up above that 106 mark in June. And historically, that 106 has acted as some sort of a resistance level. And now we are seeing that in July and August, that is retracing back into that 101 to 106 range where this RER has stayed for a long time. So this is a little bit of that adjustment on the valuation side that we are seeing. So we had a target for about 84 on INR. That's where it's settling down. But from here on, it will depend much on where the DXY is going to move based on Fed rate action.
Okay. Fair point, of course. There are too many imponderables. Mridul, I'm completely out of time, but I'm going to take the liberty, a 10-second answer. The economic survey threw this question that should the Reserve Bank or the MPC only look at CPI minus food? Should we take that seriously, or will life go on as before?
I think the life needs to go on as before. This has come up as an issue. But even when the inflation target was set, there was a clear big debate within RBI on this. And we took the call of making headline the meat breaks, essentially because frequent supply side shocks and large supply side shocks lead to generalization of the inflation. No country in the world is sort of targeting core as its measure. Even the advanced economies are actually looking at the headline numbers of the CPI inflation. So the matrix can't really be changed when you have food as 46% weight.
Fair enough, fair enough. I believe it is only Japan and Thailand. So perhaps that's a debate which is uncalled for at this juncture.
Correct.
Thank you very much, gentlemen. Out of time, so it does look like the RBI status quo policy has all of your agreement. Thank you very much for joining in this special monetary policy discussion.